We got some very interesting oil market news in the last couple days. In spite of the rising geopolitical tensions in the Middle East with President Trump's airstrike in Iraq on the Iranian military leader, or one of the Iranian military leaders, and and the other guy who was just behind him in rank, the oil price had a correction today. And also Bloomberg is reporting, this other article is from Civitana Paraskova. U.S. oil drillers rush to hedge production as oil prices soar. So a lot of shale producers, according to sources with traders, and Bloomberg is reporting this, that shale producers took advantage of the oil price rally and placed additional hedges, such as option strategies, on Friday to lock in higher selling oil prices for not only 2020 but also 2021. People with knowledge of the trades told Bloomberg the strategy is to purchase financial options, allowing producers to ensure a minimum price for their crude oil and protect their revenues and production in case oil prices snap sharply back, which would indicate that a lot of oil producers in the US, especially shale producers, don't believe this oil price rally will last much longer. Also, Bloomberg is reporting that I believe some North Sea oil producers, apart from the US producers, companies active in the North Sea have also increased hedging activity in recent days, traders told Bloomberg, after oil prices hit their highest level in 7 months, amid fears that a U.S.-Iran conflict may be imminent. So if you want to read more of that article, I will put it in the information and description section. That came out today. But the main reason I'm doing this podcast is a story that came out from Nick Cunningham, January 5th, 2020. He is one of my favorite oil investigative journalists. He covers a lot of good topics for oilprice.com. His articles are routinely on Zero Hedge, and he was digging into a Dallas Federal Reserve survey, and there's some very interesting things in the Dallas Federal Reserve survey. In fact, it proves that a lot of people don't know what they're talking about and are believing lies and bullshit. People like Peter Zeihan, who is going around giving expensive speeches and speaking tours and book deals and consulting gigs and all this other stuff, claiming that U.S. shale oil producers are profitable and generating enormous amounts of free cash flow at $35 a barrel. He is a big shot. He is probably overcharging the Pentagon and other people big bucks. I've seen one of his presentations. They're all over the internet. He has these charts and graphs saying that shale oil is now lower cost than the majority of the world's oil production. I've seen the charts and the graphs saying that $35 now is the production cost for U.S. shale oil producers, that miraculously over the last 6 or 7 years, shale oil producers have been able to cut production costs from about $70, $80 a barrel down to now $35 a barrel. They are generating enormous free cash flow, and they are the envy of the world's oil producers. Well, guess what? The Dallas Federal Reserve had an anonymous survey from U.S. oil executives, and these oil executives said anonymously that that's not the truth. So let me talk about this article. Some of the stuff in this article totally disproves what the supposed experts like Peter Zeihan and even the shale oil companies, what they're putting out in their public presentations, are saying, because these oil companies are saying that they can generate free cash flow at $50 a barrel. That is not what these oil company executives are admitting anonymously. So his article from January 5th is U.S. shale struggles to ride out the storm. U.S. drilling activity continued to contract in the fourth quarter, and the sense of gloom among shale drillers in Texas remains palpable. The latest data from the Dallas Federal Reserve shows that the Business Activity Index, a broad measure that captures conditions in the energy sector in Texas, remained in negative territory, although narrowly slightly from a reading of minus 7.4 in the third quarter to minus 4.2 in the fourth. So there has been some improvements, I guess, because the oil price has rallied. Oil producers are trying to ride out the storm, but that means a steep fall in activity for service firms. And normally what service firms do is they cut the cost for drilling to try to get business, which means they cut margins. The activity reading for the oilfield services segment saw a minus 22.1 reading. Anything in negative territory signals a contraction. E&P firms, which is exploration and production if you're not familiar with the oil industry firms, specifically saw modest growth, with the index rising from 0 to 5.4 in the fourth quarter, but employment posted a third consecutive negative reading. The Dallas Fed Energy Survey offers a treasure trove of information. This is the best part of the article. The quarterly release asks a series of questions to which oil and gas executives respond anonymously. So if they're responding anonymously, they probably no blowback for lying to shareholders. Well, at least not directly. Now, if you're a class action, if you're a securities lawyer, maybe you can sue them. Maybe you can figure out, maybe you can dig. If you're a hedge fund, maybe you can dig, figure out which executives are lying. To which oil and gas executives respond anonymously, which allows them to speak frankly. The survey reached 170 firms, 111 of which are exploration and production firms, and another 59 that were oilfield service companies. So it was a pretty broad survey. Sounds like they did a pretty good job here. As such, it produces a kind of unvarnished gauge of sentiment in the Permian, although it should be noted that a handful of oil majors make up an increasingly large portion of activity, something that is not captured in the survey. So they're surveying private oil companies that are not listed on a publicly traded exchange, but increasingly more so ExxonMobil and Chevron and some of the other larger either independents or super majors are big investors in the Permian. The Permian is one of the last major basins that still has growth, although there are a lot of signs that the growth is starting to rapidly slow in the Permian. Steve St. Angelo and others have covered this. There is still probably some more growth ahead, but it's nowhere near the levels, and the other shale oil basins like the Eagle Ford and the Bakken are basically done. The growth is done, especially with the Capex budgets that have been cut, the amount of Capex that has been cut. There was a lot of money thrown into those shale investments, into the Eagle Ford, the Marcellus, which is natural gas. Eagle Ford also had a lot of natural gas. There's a lot of natural gas byproduct to shale oil, and a lot of it's being flared. Steve St. Angelo just covered this. The amount of shale oil being, the amount of shale natural gas being flared in the Bakken is nuts. Because it's not economic to build pipelines, and it's not economic to build storage tanks for the natural gas. Okay, so back to the article. Unvarnished gauge of sentiment in the Permian, although it should be okay that a handful of oil majors make up increasingly large portion of activity, something that is not captured in the survey. So ExxonMobil and Chevron are still heavily investing in the Permian, but there's been a big cutback from a lot of other companies in Capex investments. For several quarters, the surveys have been downbeat, and the fourth quarter was no different. The survey found that 41% of all firms expect to cut spending in 2020, while 34% expect to increase Capex. So the majority of firms, 41%, are cutting spending, cutting Capex, which means there's going to be job cuts, or people to stay on payroll are going to be asked to take pay cuts. Capex cuts are bad for human beings. That means either you're going to lose your job, or there's going to be less paid work, or you're going to be asked to take a pay cut to stay on. The vast majority of companies are basing their 2020 budgets off of a WTI price between 53 and 56 per barrel. Currently, right now, WTI is above that at almost $63 a barrel, at $62.69 when we're doing this podcast. So there's been quite a bit of a rally in the oil price, and that has raised the oil price above, which is why a lot of these oil companies are hedging. They're worried that oil could go lower if geopolitical tensions calm down, if there's not World War III, as some people are thinking that there might be. So this is the most interesting part of the article, in my opinion. The responses on break-even prices were also revealing. Now, break-even does not mean free cash flow, guys. Break-even means you're not losing money producing each barrel of oil. You're breaking even. So it does not mean free cash flow. It means that you're treading water. Only 41% of companies surveyed said that they could break even at $50 a barrel. Wow. And another 40% surveyed said they needed prices above $55 per barrel. And yet they are telling investors in their public documents that they are break even at 35, that their costs are 35 a barrel. A lot of these companies are. That they can generate free cash flow at $50. These companies, so anonymously, these companies just said that their break even, which is not free cash flow, that their break even is $50 or above $55 a barrel, large chunk. So there you have 80% of shale is break even. 80% of shale is break even in $50 to $55 a barrel. Not free cash flow. So these publicly traded companies are telling their investors in their investors' presentations, in their annual reports, that they are generating free cash flow at $50 a barrel. Okay? Meanwhile, they're anonymously telling the truth on the Dallas Fed surveys that they're barely break even at 50 a barrel. Some of them are not break even at 50. Some of them need 55, 60, 65 a barrel. So there is clear lying. Okay, someone will connect the dots. Hopefully it'll be a securities lawyer or a hedge fund. Because these Bethany McLean did it. She connected the dots. She's a good investigative journalist. She wrote Saudi America, the book I've been recommending. It's like about 4 hours on Audible audiobook. I recommend you read it. But this is more proof. Because I've seen on the public documents, I've seen articles, I've seen a lot of material out there on investors' presentations, quarterly reports, annual reports, on conference calls, that, and also raising money from investment bankers that it is $35 a barrel cost. And that's not what the industry executives are saying. Anonymously, of course. So big discrepancy. There's an opportunity there, Tomcat, for a lawyer to make a lot of money. It might take a few years in a class action lawsuit, but there's an opportunity there. Pudenda scale doesn't mean a lot if costs keep rising. Those sweet spots will be drilled, and then the Capex will increase. It's all about Capex. Those sweet spots in all the basins were all drilled early, and they're not going to be able to continue to lower prices, to lower costs to drill. The Capex budgets are going to start rising again. So meanwhile, people like Peter Zeihan and others are getting fooled that shale is the most profitable oil now in the world. He's actually telling people that. I've seen that in his presentations. He just did an interview on Financial Sense talking about how the U.S. now has the lowest cost oil production in the world, lower than most OPEC countries. So he's quoting that number, that $35 a barrel, that the U.S. is generating enormous free cash flow from their oil production. Meanwhile, can the guy even read a balance sheet? Can he even look at the financial disasters that many of these shale oil producers are? I'm sorry, but if you're charging 6 figures or 7 figures or whatever he's charging, if you're making that, you should be able to do this type of research and analysis. But maybe people don't want to hear the conclusion that shale is not generating enormous free cash flow. The costs are not $35 a barrel. Even EOG Resources, their costs are not $35 a barrel. And EOG runs about as tight of a ship as there is for the shale producers. EOG is saying that they can generate free cash flow at $50 a barrel, but I doubt their costs are $35. So I have a number of other articles about shale oil bankruptcies. 2020, the year of oil bankruptcies, by Alex Kamani at Oil Price. This is from last week, December 29th. Bankruptcy boom has hit the oil and gas industry. It's just getting started. Investors have lost their appetite for shale, and energy debt has been among the least desirable in the market. So this goes to the next couple sentences of that Nick Cunningham article, where in the comments section, where oil executives can anonymously write in comments on the survey, there were a handful of themes that respondents kept circling back to: the lack of access to capital markets, financial struggles, and consolidation in the services sector. So here's some anonymous responses from oil executives, and this is, again, disproving Peter Zeihan's thesis. Below are a selection of comments from various oil executives, anonymously, of course, which offer a glimpse into the mind of Texas drillers. Quote, "We are having to divest properties in order to keep from dropping employees," end quote. Quote, Many non-conventional shale wells are not achieving production expectations, thereby constricting cash flow for new wells and projects, end quote. Also around here, the Wall Street Journal in the last week or so has released 2 articles confirming this as well. You have banks get tough on shale loans as fracking forecasts flop, from December 23rd by Christopher Matthews, Bradley Olson, and Allison Prang. And then on December 29th, you have As Shale Wells Age, Gap Between Forecasts and Performance Grows by Rebecca Elliott and Christopher Matthews. So back to some of these quotes that are, of course, anonymous from oil executives who are actually telling the truth, unlike their investors' presentations and many of their annual reports and many of their quarterly reports. And of course, anytime they get in front of investment bankers or pension funds or private equity. Quote, small upstream oil and gas at investors' presentations. Quote, small upstream oil and gas, although I would say a lot of pension funds don't believe the bullshit anymore, which is good, thankfully. Quote, small upstream oil and gas operators may find it increasingly difficult to schedule drilling and completion services as consolidation of service companies continues to occur. Quote, the capital infusion has all but ceased for small exploration and production companies with regard to developing properties. Quote, continued weak oil prices and high costs are squeezing my margins. It is very difficult to find any projects that make sense economically. Quote, increasing regulatory pressure in Colorado has resulted in a complete loss in value of wells in that state, and in my mind, it has become a no investment state. Probably because they turned Democrat, although there are a lot of problems with shale oil wells, but oil does create jobs and investment. So it's a complicated situation because people want jobs, but there's a lot of problems, obviously, with shale and fracking and the water and the infrastructure, the roads. Chris Martinson and Steve St. Angelo have covered this a lot. Chris Martinson at Peak Prosperity, how a lot of these states where shale is in North Dakota and others, the roads are totally destroyed and then the infrastructure needs to vastly be improved, and the oil companies don't pay any money to improve the infrastructure. And the oil companies don't like paying extra money to clean up the frack water either. Quote, Henry Hub Gas and NYMEX West Texas Intermediate oil price oil index prices are now meaningless to me, as purchaser deductions have brought the real world price to $1.60 per metric cubic feet in West Texas and Central Oklahoma. So the cost of natural gas is so low that it doesn't matter. Major new worries are starting to be operator solvency, bankruptcy. So the amount of natural gas available and the price that this person who submitted this anonymously can sell it at it's nowhere near economic, basically. The natural gas price, let me look this up. Natural gas is 2.154. And this guy said it's 1.6 is what he could get. So it's nowhere near economic. It's an enormous loss. So the natural gas production in those basins that he talked about in the survey, enormous losses. In West Texas and Oklahoma, enormous losses on the natural gas. Okay, so I have a number of these articles I can put in the information and description section if you want more, but I thought that was interesting because, again, this disproves the false narrative out there from Peter Zeihan and also from investors' presentations and annual reports and quarterly reports and conference calls from shale oil company executives saying that their costs, they can generate free cash flow at $50 a barrel. And there's a lot of them out there claiming that they can generate free cash flow at $50 a barrel, that their costs are $50 a barrel or their free cash flow at $50. Because they submitted anonymously that they're barely breaking even at 50, or a larger chunk are not break even at 50, it's 55 a barrel or higher. Pugenda says depends on what basin they're in. Well, the investment into the Eagle Ford and especially the Bakken are down to a trickle. It's almost zero. There's very little capital available anymore. So the survey talks about this. There's been a bunch of articles that there's very little capital for a lot of these shale companies. There's going to be forced mergers and acquisitions, but I don't think a lot of these companies are going to sell for premiums. The Capex bills for some of these shale wells are absolutely enormous. For the oil companies to do better, there needs to be a sustained higher oil price. The problem is the global economy can't afford a much higher oil price, because then it starts to act as a tax. It would be like if the Federal Reserve increased interest rates a lot more. Remember how they almost broke everything in December of 2018 with the interest rate hikes. So the oil companies themselves as of now, the oil producers themselves do not believe in the rise in oil price. But I would take that with a grain of salt, because a lot of these oil company executives, when they're asked for oil price predictions, are routinely wrong. I have not read or seen or heard an oil industry executive at one of these major oil companies actually make a correct prediction on the oil price in a very, very long time. Most of them have absolutely horrendous track records for predicting the oil price. Even 1 year out or 2 years out. ExxonMobil will have to make big write-downs on XTO Energy. There's a lot of analysts, in my opinion, this is what I've read. Number of analysts think that they will have to write off $30 billion, the $30 billion acquisition, the full amount. IBJI says a Barron's article gave EOG a $110 price target. I haven't looked at EOG in a couple weeks, but the last time I looked at the company and the investors' presentation, it looked like a very well-run company. They do generate free cash flow, and they do not have any waste. Management is no frills, very frugal. They don't waste money on a fancy headquarters or any of the stuff Aubrey McClendon was doing. The stream was offline briefly? That's weird. I didn't know that. Oh, I'm glad you like the cover graphic. I found a similar one to that and made a few changes because it had an old $80 a barrel break even. I changed it to 50 because the industry is telling everyone that 50 is a new break even, and there's even industry presentations that the cost is down to 35. Like Peter Zeihan for a year now has been telling people that shale is economic at 35 or something. The costs are at 35. Yeah, when I saw him do that on a presentation, I was shocked. I was like, their financials, the financials of any of the shale producers do not reflect that. They would not have bad balance sheets if that was the case. And most of them have really, really bad balance sheets. This is a good question. Is the $50 break-even price the reason why Trump started a war with Iran? It might be one of the secondary or tertiary reasons. I doubt it was the primary one. There's also one of my China contacts on Twitter said that the guy that Trump took out in the airstrike, whose name I can't remember offhand, in Iraq, that guy, he owns a bank in Iran that does all the China oil deals. So I haven't looked into that more, but that's what he was saying. So that may be one of the main reasons. That his family owns multiple mansions in Hong Kong, mansions in China, and that he not only was he a butcher, a war criminal, that a lot of American soldiers and others, killing his own people, and a lot of people hated that guy, but also he was a big rich player in getting the Iranian oil to China, and his family owned the bank. I didn't say we're at war with Iran. We're not at war with Iran yet. Well, the neocons wanted to attack Iran when George W. Bush was still president. I mean, this has been going into effect for a long time. what was it, General Wesley Clark spilled the beans that there was a plan to attack all those different Middle Eastern countries? You don't like Chris Martenson? You called him a globalist? Hmm? Okay, I'm going to take another quick look at listener questions and comments, and that's about it. Wrap up the show. Hopefully I will be able to work on some of my other projects. I have a couple other slide decks I have to finish with some audio and some editing. Albert says oil is rising, so shale bust is delayed indefinitely. Albert, I disagree, because the question then is, can these shale oil companies, how much of their production can they hedge? Are they hedging, locking in free cash flow, and can they raise capital? Or can they sell the company in a merger and acquisition? Because if they hedge, but they're not hedging enough for free cash flow, and they're not hedging enough at a profit to pay off their debt, or they can't the whole game is about refinancing, because a lot of these shale companies, they cannot raise capital. So they either need to refinance or restructure restructuring would involve bankruptcy. So that's like the last option. But refinance their debt or roll over their debt. Maybe extend the duration. So push it out years. So keep the amount the same, but push it out for years more. So I don't think the shale bust is delayed indefinitely. But I think if the oil prices stay at these levels or go higher, there will be more shale oil companies that will be able to refinance or roll over their debts or sell out for probably not a premium, but at least not a big loss. He's OORPHB says shale can't be profitable at any price. I disagree. They've gotten the cost down for shale a lot. So if oil prices went to 100, it could be profitable. The problem is at $100 a barrel oil, then it acts as a tax on the global economy. So then a higher oil price like that could accelerate a collapse in the global economy. Energy return on energy invested, in the short term, it does not matter, because you've had the pension funds and the Federal Reserve and large Wall Street banks, also like the local banks in the area of like Oklahoma and Texas, just subsidize shale. So shale has energy return on energy invested does not matter when the Federal Reserve and pension fund, Federal Reserve can print unlimited money and credit for a while, and that's what's happened in the last 10 years. Excellent question. Can the government bail out the shale companies? Maybe. Or they can force mergers and acquisitions, or they can offer maybe Chevron or ExxonMobil some type of subsidy to do a buyout. Maybe. I mean, we're in uncharted territory here. The Fed cannot create, I agree, the Fed cannot create real value. The Fed can create an illusion, though, of liquidity and, an illusion of solvency. So energy return on energy invested has not mattered, while the Fed has allowed the banks to paper over everything. The pension funds were also suckers in this. I mean, a lot of these pension fund managers and the pension fund advisory boards, they should get fired or sued. The majority of people in pension funds are managing pension funds are incompetent. Yeah, so temporarily energy return on energy invested can be papered over, and that's what's happened, I think, in the last 10 years. I've talked about this a lot in the last couple months. Now, obviously, permanently it can't, but for 10 years it could. Good question. Douglas asks, aren't these interest rates at least a partial bailout? Yes, But the shale oil companies added so much debt that even a little increase in interest rates would hurt them. So now in the next 3 or 4 years, there's $100 billion in shale debt being due. Actually, the U.S. run it with the world reserve currency. The U.S. has to run trade deficits, and that means there's demand for dollars globally. It's more complicated than that, Pudenda. There is a permanent demand for dollars. And then you have dollar-denominated debt, and you have all the dollar liabilities, over $24 trillion. That creates demand for dollars. If you don't make your payments on your dollar bonds, you collapse immediately. If you don't at least make payments. We're on the U.S. the global economy right now is with the dollar as world reserve currency and no gold backing. We're on a dollar standard. So to say that the U.S. is subsidizing shale just so that way there's dollars needed is inaccurate. The U.S. has to run trade deficits. It's far more complicated than that, and saying dollar collapse and look, if these other countries wanted the dollar gone, they should not have borrowed in dollars. It's that simple. If these other emerging markets wanted the dollar gone, they should not have borrowed in dollars. They should not have also used dollar liabilities like forward dollar swaps. And yet they did. Massive amounts of them in the last 10 years. They should not have done it. So you have, like most people in power, you have the people speaking in a press release saying one thing and their actions are doing another. So you have China, Russia, and these emerging markets saying we need to get rid of the dollar. There's so many problems with the dollar. And then meanwhile, a lot of these governments borrowed massive amounts in dollar-denominated debt. All these countries have real high inflation rates and are lying about it. Albert says the shrinking trade deficit is a sign of a recession coming. Also, a shrinking trade deficit is a sign of a dollar shortage, because the U.S. needs more of those dollars to fund the budget deficit. And then also the quantitative tightening and some of the other programs that the Fed did in repo and the foreign reverse repo facility that was pulling dollar reserves out of the system here in the U.S. And the Fed needs to sell treasuries, and that's pulling dollars out because the Fed needs treasuries. So you have, this goes back to my dollar tug of war. Again, you have people, look, I like Rob Curvey, very smart guy, but he's been calling dollar collapse for how long? There's a dollar tug of war. There's a legit, you have to look at the argument on the other side. There's a legit dollar shortage too. And this is because a lot of people overborrowed in dollars. Anyway, I don't want to have a macro discussion today. There's two really powerful forces pulling on the dollar. It's probably the dollar index has been in a downtrend for a little bit, but I don't expect it to go down a lot more. Oh, thank you for the super chat, Chen. I appreciate it. I think countries are copying Japan. As an Austrian school economist, what these countries should do is they need to cut government spending. That's not happening. The exact opposite's happening. The size of government, the size of the central bank balance sheet is staying the same or increasing. Yeah, it's counterintuitive that the yen is strong. Well, the Japanese also buy a lot of U.S. Treasuries in dollars, so the market accounts for that. Now, I don't want to have a long global macro discussion today. Otherwise, I'm going to be here too long, and no one's paying me extra for a macro discussion right now. I could do that on another show, or I could do that behind my Patreon account paywall. Okay, well, that's it for tonight. I want to thank my over 200 Patreon account contributors. I may work on another interesting podcast. I may look at the uranium royalty company. That may be a bonus podcast just for my Patreon account contributors in the near future. So I want to thank my over 200 Patreon account contributors, my dozen or so monthly PayPal contributors, and people tip me once in a while. There has been an issue with about 20 people with their credit card and debit card companies on my Patreon who had their Patreon account contributions canceled at the end of last year, early this year. So in the last 7 or 8 days. So if you could take a look at that and make sure that you're still a Patreon account contributor, that would be great. There is more interesting content coming behind the paywall on Patreon. And I'm seeing that YouTube is starting to really censor things for Bitcoin and crypto and also some of these other channels that I follow. So if things do get worse here, then unfortunately more and more content will go behind the paywall on Patreon. But on the bright side, then it will be recorded in studio quality with Zencaster. So you will get higher audio quality as opposed to just a live stream program here.